everyone. Rich Sassman here with Century 21 and Scott Swinford with Hancock Mortgage.
Hey, everybody.
It's another Mortgage Tip Monday. A couple weeks away from Christmas. We're down to nitty-gritty in the end of the year. Yeah.
I can't believe it is already the 9th of December.
It's flying by fast. It still feels like it's November. Let's be honest. So if you watch this every week, please give us a like and share. Give us that little heart emoji. It would mean the world to us. But basically what we want to talk about is like the buyer's mindset. What type of mindset do you need to have as a buyer? And for me, one is willing to learn, because it's a process that we do every day of our life. And it's a process that most people that are buying houses through us don't deal with that often, and every 5 years. And so things have changed. So listen to us about the process. We know what I know what the housing market is like. I know what offers are getting accepted and what's being unrealistic and stuff like that. And Scott, I mean, he's the gatekeeper for your finances. So if you're willing to learn from him and do what he says, guess what? More than likely, a deal's gonna go through for you.
You know, we have been pretty successful with our clients that follow our instructions. Well, some of them, I mean, granted, sometimes it seems really tough.
Yeah.
Like, don't rack up your credit cards again, or they're not sure why. If we say, it's okay to go out and find the furniture you want, but don't buy it before closing. Don't open up a credit card to get it. A lot of those little things out there that may not make a lot of sense initially, but for us, it's because we know that these are things that can be detrimental to you. So we want to keep you moving as quickly ahead as you can, and as smoothly. That's the whole idea.
Yeah, and so my job is to work with the other agent in the transaction and bring everybody to a understanding on what how to get to the closing table. And that's compromising on both sides. That's getting you the best deal possible. And it's also about trust. And I trust my clients that they're going to do the right thing for Scott, and they're not going to ruin the deal at the 11th hour. But sometimes it does happen. And I also ask for your trust and listening to my advice when I say, hey, it's a buyer's market. There's 2 other offers on here. Maybe we shouldn't go 20 grand less than the list price on a $150,000 house. So I don't think your offers can get entertained too often. And it's just little things like that there's a reason why you chose to work with me, and please let me help you get into your dream home. And that's all I ask. And I want you to question me and ask me why I say this and whatnot, because I will always have an answer for you. I will not just say things to say them. I will say things because they're real and I have evidence to support it. So it's not oh yeah, I feel like you can offer this price and have a good chance at getting it accepted. It's I ran the comps. I ran the past sales in the area. I know exactly what this house is gonna get sold at, and even appraised at. More than likely, I can get pretty close to the appraisal price because we use pretty similar formulas. So,
right. And it makes a lot of sense. If you haven't done this, now let's take you, looking at you as a potential buyer. How many homes have you bought or sold or financed already this year? Have you sold 10 homes, 12 homes, 20 homes? Have you financed 20, 30, 40, 60 homes? So you should leave it to the folks who do this every day, who are going to guide you. And I know you can read some of the books, and there's things out there like how to invest in real estate. And the first thing you should do is you go in there and offer them 50% of the list price, and then you start taking things down. Well, it needs a new furnace, so that's $15,000. By the time you're done, the people who are selling a house actually are going to have to pay you to take it. So understand what Rich is telling you and the reasons behind it. Again, we're not going to make up reasons for things.
Nope.
It's based on facts, based on experience. And when you look at things, just like you said about appraisal values, they look at sales and comparables and things in the area to help come up with those numbers.
Mm-hmm.
And likewise, on the mortgage side, one of my most important jobs is to make sure that you're going to be comfortable with this payment and that we're doing the best for you that we possibly can. And that means getting you the right interest rate at the right cost, at the right term. It may not always be the lowest rate. And I hear that all the time. People ask me, well, I can get a better rate down the street. Okay.
Mm-hmm.
Well, those aren't the two questions, because rate can be changed. You could get a lower rate, but it costs you $10,000 or $12,000. And if it takes you 10 or 12 years to recuperate what it costs you to get that rate, does it really make sense? So all those things need to be taken into consideration,
Mm-hmm.
and that's what we do. And again, that's one of the reasons we do these videos every week, is so that hopefully we can get that information out. Rich can share some of his experience as a real estate agent,
Mm-hmm.
being out there, being in the area, being in the locale and seeing what's happening in Crown Point and Highland and Cherville and the other areas that he covers. And then I use that experience with him to help you get the best deal we possibly can.
Mm-hmm. Yeah, and like he said, we do this all the time. This is what we do. My team, I think my team's over 24 million this year in sales. So we bring that experience, and we bring that, instead of you selling your $300,000 house, well, you have $300,000 in sales. Congratulations. But it's just challenge us. Feel free to challenge us on what we're saying to you, and we will always provide the evidence why we think that. And if you do have a lower rate from somebody else, and you're talking with Scott, ask him why yours isn't that low, and he'll compare apples to apples and show you how you're getting that rate and how much it's costing you versus his and whatnot. So, and let you make up your own decision, but once again, he will provide that evidence all the time.
Absolutely. And I had a client we closed a couple weeks ago,
Mm-hmm.
who said, well, this local bank is giving us this interest rate, and it was 0.25% lower than what we had. I said, and remind me again why you're using me. And he said, because they denied us. So if you can't get the loan closed, it doesn't matter what interest rate they quote you. I mean, let's just be honest about that.
Exactly. Some banks will offer a really discounted rate, but their qualifications are going to be sky high. So if you're borderline, wait till you get to the closing table. If you can't get there with them, then it's not really a real quote on interest.
Exactly. And we need to talk about rate locks, because that is when the actual rate happens.
Yes.
So I could quote you. You want to rate it 2%? Sure, no problem, 2%. Send me all your docs. In fact, you know what? While you're at it, maybe send me like a $500 non-refundable application fee, which a few banks do. We don't, by the way. And then when we get you through 45 or 60 days later, and we're ready to lock the loan, I say, okay, your interest rate is going to be at 5.25%.
Yeah.
You're like, wait a minute, you told me 2. Well, that was back then, and again, that's just an estimate. We were just guessing what it was, but this is where rates are at today. So be cautious again when you're looking at those things. It's just like anything else in real estate.
Mm-hmm.
Do your homework. Make sure that you're talking to the pros, the people who you trust. They're going to take care of you. That's what we do.
Exactly. And once again, if you get some valuable information out of these every week, please like and share this. It means the world to us when other people get to see what the education that we're trying to put out there for you guys. But please, if you have any questions, don't go into a sale of a home without getting your answers asked or your questions asked. We give the answers, you give the questions. And it annoys me the most when clients don't ask me the question, no matter how simple or how stupid they think it is. There's no stupid questions. Stupid people, but no stupid questions. Ha 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 ha. No, I'm just kidding. But so I've heard every question. Please ask it. Just ask it. I buy and sell houses for my clients all the time. This is what we do. We've seen everything, and if I haven't seen something, I'm betting to guess somebody in my office or on my team has seen it.
And if you have that question, more than likely somebody else has had it in the past too.
Mm-hmm.
So it's not a dumb question.
No.
There's no, and part of what Rich and I try to do here again is, we want to blow away that smoke and break those mirrors. There should be no smoke and mirrors in a real estate transaction. We want you as part of our team, just like everybody else here, just like the home inspector and the appraiser, my processor, my underwriter, and Rich and his team. You're part of our team also. And in fact, you're the reason that we're out there playing. You're kind of our star player. So we want to make sure we're all working together and that each of us understands what the other one's responsibilities are. If you ask me a real estate related question, I'm going to refer you to Rich. It's not what I do. If you ask a mortgage related question, he's going to refer you to me because that's not what he does.
Nope.
Because we're specialists in our own field.
And I've actually had people come to my open house that asked me a mortgage question, and I got Scott on the speakerphone and was like, hey, we have a question about the mortgage process. Can you answer this? And he answered it right over the phone, and the people were surprised about our communication level, and that's just how we operate. If somebody has questions, we get them answered. That's why we work for you.
Right.
So,
you see Mike's question?
Whatever happened to the old 80 on loan, 20 on another loan, get around PMI? Is that still around? Let's see. I'm going to defer that to you because I believe that's your territory.
Might be a mortgage question.
Yeah.
To my knowledge, there are a couple banks that do 80-20 loans in specific targeted areas. But after what happened in 06, 07, 08, we're not seeing a lot of 100% financing outside of USDA and the VA loans.
Yes.
So do we have the ability to do like an 80-10-10? We do, where you can take one loan for 80%, another, and these are like investor loans times, another loan for 10%, where your mortgage insurance is not required. But just understand though, now we're dealing with the law of risk. So if you have one lender who has 80% of the entire loan, so let's say, for instance, it's a $200,000 house, they're writing a $160,000 loan, probably not a lot of risk there. Now you've got another bank who's coming in the second lien position that is taking up a part of that. So if something happens, you get foreclosed on, the first bank, who's got the bigger portion, is in the first lien position. And if there's any money left, then whoever's in the second lien position, and then even in the third lien position, would get paid.
Banks don't like to be in second position.
Third position, which is why we don't like closing if you have open judgments and things, because those can go in a first lien position. So because that second bank is taking a greater risk, if something were to happen, they need to reflect that in the rate that you'll receive. So we don't see a lot of that anymore. Again, there are some of those out there, but there's better ways to work around it. And if you look at the main loan and the second loan, and you calculate what the average interest rate is for those, because again, remember the second is going to be higher. If you calculate what your average interest rate is, it's oftentimes lower than what it would be. It's higher than what it would be if you were taking out one loan, and we just need to figure out then what to do with the mortgage insurance and how to handle that best for you.
Yeah, and there's also ways of, if you want to get around PMI, you could also prepay it. So, in occasions.
You can.
In occasions, there's...
Well, you can. I'll be honest with you.
Yeah. Is it a good option all the time? Probably, yeah.
Depends on how long you're going to be in your home. Because now you're paying extra money up front that's non-refundable. So if you're going to be in your home for 10 or 12 years, it might make sense to do that. It might make sense to purchase the MI up front in one lump sum. If you're planning on being in your home for 2 years or 3 years or 4 years, it might not make sense to do that.
Yeah, and it all comes down to simple division. You divide how much more you're paying and versus how many months it's going to take you to recoup that. And if you plan on being in the house more than that, then it could be a good option if you have the cash up front. Now, if you don't, then it may not be such a great option, but it is a possibility,
Right.
and it just depends on the situation. If it's your forever home that you're moving into that you love, well, maybe it's a good option. If it's your starter home that people usually only in it for up to 7 years or less, then maybe it's not a great option.
Right. And that's
So-
why we'll sit down with you. We'll run all those numbers and we'll say, if, this is option A, option B, option C. This is what I would recommend. However, we'll always let you make the final choice.
Exactly. So, and that's the thing. We'll go above and beyond trying to make sure that your best interests are being met by looking at things like that aren't as common. But you know what? If it helps you in any which way, then it makes sense for us to look at it. So, and really, it's simple division to try to figure out if it makes sense. So we're more than happy to do that. So,
Yeah, Mike, that's one thing that to hit on too is you want to, again, we always look at, we think a lot about the acquisition, how to get into a home. I want to buy this house and this is what I want. But, especially if you're an investor, but even for someone who's going to buy it and live in it for a few years, you have to ask yourself, what's my exit strategy? And am I financing it correctly if I'm only planning on staying in here for 2 years or 3 years or 4 years? When I bought my house, we had a 7-year ARM because at the time it made sense to do it. And everybody says, oh, ARMs, the adjustable rate mortgages, those are horrible. We had it for 11 years.
No, it's not horrible.
Because the interest rate kept going down on it just because of the way the margin was and where the overnight rate was at the time. So we had that 7-year adjustable rate that we kept for 11 years. And then we refinanced it because it made sense when rates started going up.
Yeah.
But it's simply that. It's just a tool.
Yeah.
And right now, I was looking at rates the other day. The rates are actually better on a 30-year than they are on a 15-year because of the way that just the way what the market is. It's the instability of the market. So if someone approached me now and said, hey, we'd like a 15-year, I'd say, I'll tell you what, let's figure out what the amortization is on that 15-year and put you into a 30-year and you make those payments.
Exactly. So, well, the fact is ARM loans are great when the interest rates are high because if they drop down, then, hey, you got a good chance at the end of the ARM. But in situations where, like right now, where interest rates are as low as I've seen them, there's only room to go up, really. I mean, how much lower are they going to keep going? Because over the summer, they were predicting that, over the winter, they're going to start going up, and they haven't really.
There are a couple mortgage gurus that I follow that have been right an extraordinary amount of time. And they are saying that within the next year, we may be in a recession. And a recession always includes lower interest rates. What they are saying is sometime within the next year to year and a half, we may see the lowest interest rates we have ever seen, which would be great. However, there's no guarantee of this. And it doesn't mean that rates won't go up before that. So it's just, it's like a roller coaster. The question is it like one of the big roller coasters at Six Flags Great America? Or is it a little roller coaster like you put your kids on at the fair?
Hopefully a nice slow one. It makes everybody happy usually.
But when you see it start to go up like this and then down and then up and then down, it's
very chaotic.
And it can, it can be tough because you're thinking, am I getting in at the best rate? Well, it's hard to say.
I like kiddie coasters when it comes to that.
Kiddie coasters are good.
Shout out to former Kitty Land and the Little Dipper there. But yeah, if you have any questions, if you want updates on the mortgage industry and whatnot, feel free PM Scott your your email address, and he'll put you into his database, and you'll get emails every so often, just so with market updates and everything in the mortgage situation. So other than that, please like and share this. It would mean the world to us. Once again, I think I've said that 3 times now. That's how important it is to us. So other than that, if you have any questions, feel free to DM us. We're more than happy to answer any questions you guys have, as we do every week.
We're here to help.
Until next Monday, that's Scott Swinford. I'm Rich Sassman, Hancock Mortgage, Century 21. Everybody have a great week, and we'll see you next Monday. Woo.